Hi guys, welcome back to my channel and thanks for clicking on to the video. So in today's video I have following transactions and I will explain you how to pass these entries without the help of any golden rules of accounting, and yes, with the help of a very simple debit and credit table. Let's get started, and this is the table I am talking about. This table helps us to know whether we have to debit any asset, liability, capital, revenues or expenses, or we have to credit them. So first one is assets, and whenever assets increases we have to debit them, whenever they decrease we have to credit them. Liabilities are opposite of assets, hence they will be debited when decrease and they will be credited when increase. Capital when decreases is debited and when increases is credited. Revenues or incomes. So revenues and incomes are debited if they decrease and they are credited if they increase. Revenues and incomes are opposite to expenses and losses. So expenses or losses will be debited when they increase and credited when they decrease. So let's start the very first entry, which is salary paid rupees 5,000 and wages paid rupees 1,000. So first account is salary account. We just have to classify these accounts into assets, liabilities, capital, revenue or expenses, and then see whether they are increasing or they are decreasing. So first one is salary account, which is we are paying salary off. It is an expense, and expense we are paying off, so it is increasing. Second one is wages account. Same with this, we are paying off, hence it is an expense, increasing. Third account is this, which is cash. We are paying off cash, so third account is cash. We'll include the amount 5,000 plus 1,000. So cash is an obviously asset, and we are paying off the cash, so cash is going out of the business, that is it is decreasing. Okay, so in the case of expense, if the expenses increase we debit them. So both are expenses and both are increasing, that's why we'll debit both of these. And in the case of cash, which is an asset, it is decreasing, so whenever an asset decreases we credit that. Let's move on to its journal transaction. We have the format of journal here, so we'll do the first transaction in which we have to debit the salary and wages account. So salary account debit, wages account debit, and we have to credit the cash. So cash to cash account. Amount will be 5,000 for the salary, 1,000 for the wages, and the total of debit side and the credit side is always same. So we are paying 5,000 for salary and 1,000 for wages, so total cash is 6,000, which is decreasing or going out. Narration will be being salary and wages paid. Second entry we have is cash withdrawn by proprietor for personal use. So first account is cash. Okay, cash account. And which one is the second account? Here the proprietor, which is the owner, is withdrawing cash for personal use, not for the use of any business transaction or whatever, but he is withdrawing the cash for his personal use. So this is called drawing, as we have discussed in the previous video. So drawing account. Cash account is an asset, which is withdrawn by the proprietor, so it is decreasing and it will be credited. While the drawing account is always debited, because in the case of drawing, each and every time the proprietor will withdraw any asset, for example cash or goods or any furniture, that will be going out of the business and that will be always credited, while the drawing account will always be debited. Journal transaction for this will be debiting the drawing account. So drawing account debit to cash, because cash is withdrawn, being cash withdrawn by proprietor. So amount rupees 2000 and 2000. Third entry is paid sales tax and income tax. So first account is paying off, so paying in the form of obviously cash. First account will be cash account. Second one is sales tax. We are paying an expense named as sales tax. And the third account is income tax. But sales tax is an expense for the business because business pays sales tax for the annual sales. But income tax is paid by an employee or any person who is earning income. But business does not earn income. So income tax is being paying off from the business in behalf of any employee or maybe the owner. So it will be termed as drawing account. Let's classify them. Cash account is an asset, sales an expense, paying off the expenses, so cash account or the asset is decreasing and we will credit it. Expense is increasing and they are debited if they increase, and drawing account, as I mentioned, it is always debited. So moving on to its journal entry, sales tax account debit, drawings account debit, to cash. Amount is 10,000, 5,000 and the total will be 15,000. Narration will be being sales tax and income tax paid. Fourth entry is goods costing rupees 800, sales price rupees 1000 were stolen. We are facing a loss for sure, and we consider the loss by theft account. So this is the loss which we are facing, and the goods are stolen, that's why loss by theft account, which is obviously a loss. This loss is increasing and we debit the losses when they increase. So first account will be this, and the second account is the goods, because goods are stolen but we do not credit goods. We are considering the purchases account because we assume that the goods which are stolen, we have purchased them. Generally, purchases account is debited because the goods are coming into the business, but here goods are lost, so they are decreasing. So our goods are decreasing, so we will credit the purchases account. So loss by theft account, debit. 2. Purchases account, being goods stolen or lost by theft. And we are given the two amounts. First one is the cost price and the second one is sales price. So we always consider the cost price because we have purchased the goods which are stolen at the cost price, of course. So cost price, which is 800, will be considered. Next one we have is received rent rupees 500 and interest on investment rupees 1000. So we are receiving rent, hence it is an income. First account will be rent account, which is an income. Second account is interest on investment account, which is also an income. So we are receiving them, it means they are increasing. Both the incomes are increasing and incomes are credited when we are receiving rent and interest on investment in the form of cash, obviously. So cash account will be the third account, which is an asset, and we are receiving the cash, that's why it is increasing, and assets are debited when they increase. Journal transaction will be cash will be debited, so cash account debit to rent account and to interest on investment account. Amount is rent we are receiving for rupees 500 and this is 1000. So cash we are getting in total is 1500. Narration will be being rent and interest on investment received. Sixth transaction we have is purchased machinery from Jai rupees 6000. So here we have first one is machinery account, which is an asset. Okay, so we are purchasing the machinery, that's why it is increasing and it will be debited. The second account is purchased machinery from Jai. That means it is not a cash transaction, so cash is not going out of the business, we are purchasing it on credit. So the second account will be Jai. So Jai account. He is a creditor and creditors are liabilities. Liability is also increasing, and whenever a liability increases, it is credited. Journal entry will be machinery account debit to Jai's account. Amount is 6000 and narration will be being machinery purchased on credit.